Ashwini Agarwal joins us now. Let's take the conversation forward. Ashwini, globally looks like markets are in a mood of risk off. What's your sense? Are we in for an extended patch of volatility with some collateral damage in stocks, or you think it's just going to be a brief while and the force of liquidity will continue to surprise us?
Nikunj, good morning. I think, the markets have been sort of undecided about the future course of action for a while now. We've seen fairly sharp pullbacks, both, in India as well as internationally. Obviously, we've seen some signs of economic recovery month on month everywhere in the world, including in India. But the question everybody's asking is, has the market already taken into account all of that potentially good news? And at this point in time, whether we should look out to March 22 in the case of India for earnings, or calendar 21 earnings in the case of the other markets in the world is the moot question. And one has to therefore make assumptions on what will be the pace of recovery post the pandemic, and whether the second spike is going to be a big one or not. You've got US presidential elections, you've got a whole bunch of uncertainties. So obviously the market is trying to grapple with that.
Right. So what has been your tone of activity, Ashwini? I mean, where are you picking your spots? Are you with the darlings of the market, pharma, IT, or you are going the classic way, where there is distress, which is go towards value, ITC, NTPC, banks?
A little bit of both, I would say. Earlier in the pandemic, and I think, we spoke about this when we spoke 3-4 months ago. In April, we came out and we said that you have to apply 4 filters to your portfolio. The first being that the companies that you wish to invest in should have a global footprint, not just an India footprint in terms of what markets they cater to. Second is that they should be leaders in the business they are in. It doesn't matter whether it's a large company or a small company, but it should have an attribution of leadership. Third is that they should have a rock solid balance sheet. And fourth is that on a continuum, which at one end has absolute necessities and on the other has completely discretionary demand, you should be closer towards necessities rather than discretionary demand. And we've kind of applied that as a stock selection strategy to our holdings consistently since then. So, our portfolio does have a significant exposure at this point to pharma, healthcare exporters. At the same time, in financials, for example, we do have some exposure, because where I think that there is a lot of value, there is probably another 6 months of uncertainty that we have to grind through. But the potential risk reward appears to be quite favorable, and the commentary coming through from the banks is uniformly reasonably constructive or better than sell side fears, is how I would put it.
Ashwini, let's spend some time trying to understand banks. The first wave of consolidation was that private sector banks gained market share from PSUs, and we saw birth of lots of new banks, RBL, AU, Bandhan. How do you see the banking space now evolving? And what will be the relevance of some of these small banks now and the old banks like Federal Banks or Karur Vyasa? What I'm trying to understand from you is that the first wave of consolidation in banks has already happened from PSU to private. Now are we looking at the second wave where the top 3-4 private banks will only become bigger?
It's very difficult to answer that question. So there is one part of the equation will continue, which is that the public sector banks will continue to lose market share. So if you just zoom out and think about the history, you go back to, let's say, to 1994. At that point in time, the PSU banks had a little over 80% market share. Another 10% was with MNC banks, and another 10% was what we now call our old private sector banks, the likes of Federal Bank, etc. Since then, the PSU banks have lost approximately 14-15% points of market share, and a large part of it has come to domestic private sector banks, people like HDFC Bank, ICICI, and so on. Whereas both the MNCs as well as the old private sector guard have shrunk. So within the private sector banks, I see a continuous churn in, just as you have seen what's happened to the MNCs and the old private sector banks in the last 20 years. There will be winners and losers. So you have to think about who has a differentiated product, who has a differentiated client base, can people get liabilities? I mean, liabilities is going to be the game. And of course, over the next 3 or 5 years, you will have a significant role of technology. I mean, which banks are able to adopt technology to implement it, to open accounts, without having ever met a customer, continue, doing business in very trying conditions, continue to cut costs with the help of technology. All these things are going to become very big determinants. So obviously the larger private sector banks who are ahead of the curve and have the money to invest in technology do have a certain advantage. But this is not to say that a smaller bank may not be able to do it, because at the end of the day, technology solutions are not necessarily expensive. They are just something that you have to do. You have to do it smartly and you have to implement it correctly. So I think, there will be winners among the small ones as well. And I think one has to be very watchful and make sure that, we bet on the right horses, as it were.
Absolutely. What about pharma? Let's talk about that as well, because you're still continuing to find select plays that are very attractive in the pharma space.
So, in the first quarter, when the results came out in pretty much every pharma company, especially people who had more export-oriented revenues as compared to domestic revenues, they did extremely well, much, much better than expectations. And some of us felt that maybe there was some carryover inventory from the unanticipated lockdown in March, which helped the June quarter numbers. But the commentary I've heard over the last month from pretty much every pharma company is that demand outside of India continues to be extremely robust. Some of it has to do with the fact that many buyers outside India are looking for alternatives outside China. They're trying to de-risk away. There is obviously a heightened focus on making sure that your shop shelves are well supplied, that your supply chain is well filled in the case anybody needs medicines. The first line of defense, medication, has probably been stocked up as well by customers everywhere across the world. So that's also helping demand. So I think, in the near term, there seems to be a reasonable amount of momentum in earnings. So while the stocks have come a long way, if you zoom out and think about it, they're still not expensive. One of the other things, I'd like to remind you is that between 2015 and 2018, pharma stocks had been complete dogs. And a lot of the stocks had probably declined in stock price despite earnings having grown over this period. So the starting point of the rally, is when these stocks were completely unloved and were very, very cheap. I mean, there are a whole bunch of stocks which middle of last year were trading at, single-digit P multiples despite having very respectable ROCs and, having a visible earnings growth over a 2 to 3 year horizon. I mean, it didn't make sense. So, I think there is some more steam left. How much more, I don't know, but things look good as of now.
Okay, so still continuing to look good. While we're on pharma associated, of course, everyone's also clubbing pharma and IT continuously, but we have actually seen them play out for different reasons, of course, but IT also playing out as a very strong theme. Is that also something that you'd be looking at?
Yes, of course. I mean, IT has also done very well, and similar, a lot of the filters that I spoke about at the start of our conversation applied to them as well. Demand from outside India, very good balance sheets. Leadership is probably more, you could argue that some companies have leadership in very select services or in different types of verticals. But by and large, that's one factor which kind of is missing. But in terms of essential, a lot of the small and mid-sized IT companies are telling us that the shift to digital is, and the work from home is giving them business opportunities, at least in the short run, which they hadn't thought about earlier, because a lot of large customers internationally, while they had digitized the front end, they hadn't digitized the core, or they hadn't digitized the middle layers. And this whole pandemic is making people realize that your entire business has to be digitized, your entire work process flow has to be digitized, which is creating a lot of opportunities for the IT services companies. Stocks continue to not be terribly expensive. I mean, they've come a long way, but they're not terribly expensive. So I think that fits the bill too.
Sure. Ashwini, do you need to also tactically position yourselves ahead of the US presidential elections? We're just about a month away. Today, we officially kickstarted with the Biden-Trump face-off as well in the US presidential debate. And there is bound to be some amount of nervousness, around the event. You got to monitor your dollar index and Dow futures on a daily basis. But do you need to also position your portfolios and your view on the market in that sense, be it a Republican or a Democrat win?
So there are two questions here, right? One is, will there be market volatility around the US presidential elections? I think the answer is yes. I think US markets could remain volatile, not because they like one outcome versus another, but I think everybody is afraid that the process of, larger section of votes being mailed in may create, complications in determining an outcome for far longer than has usually been the case. I mean, usually you would expect that on the day of the voting around the 3rd of November, by the evening or late evening in the US, you would have pretty much an answer. This time around, it looks extremely unlikely that you will have a definitive answer that day. Maybe it will be stretched out by a couple of weeks, maybe even months. The worst case, of course, is going to be if, the battle ends up in courts where whoever is the losing candidate decides to challenge the verdict on several counts. So, that is the uncertainty that the US market will deal with. So that's one aspect of it. The aspect from India is going to be, of course, you look for global market cues in the very short run when determining an outcome on the local market. But is one precedent better for India versus another? I don't think so. I mean, I think, our relationship with the US, whether it's business, whether it's economic ties, whether it's the affinity that we have to the United States because of a large Indian diaspora there, pretty much every middle-class family in India, has one or more relatives living in the United States. So, that affinity will continue. So I think, it is probably going to be a source of some volatility. But I think, as a portfolio investor, I don't think I want to take that into account as a position. If I were a trader, I might do things differently. But, I don't think, at least in our case, when we invest for the long term, it's a long-only portfolio, we see room for tactical position arising out of US elections. I mean, my answer to that would be no as a positioning answer for me particularly.
Fair point. So in that regard, Ashwini, is it safe to assume that gold will continue to be a safe haven for the next foreseeable future?
I mean, I just detest that investment. I have never invested in gold personally. Or allowed anybody in my family to do so, much to the unhappiness of several members of the family. I just think it's a waste of money. So I don't want to comment on that. It might do well, it might not. It's just a complete waste of money insofar as I'm concerned. It doesn't give you anything. It doesn't give you yield. It doesn't give you anything. It gives you a false sense of security, in my view. So, I mean, I don't want to comment anything more than that.
Of the portfolio, Ashwini, you are reasonably confident that it could be a long-term portfolio component for next couple of years, irrespective of US presidential election, coronavirus, China. You are committed to maintain 15, 20, 25% weightage to that space.
To which space? Sorry, Nikunj, I couldn't hear the first part of your question.
No, I'm trying to understand that which part of your portfolio you think you would say that, look, this is the portfolio I'm going to be, these are the group of stocks I would have exposure to irrespective of what is happening.
So, one of the lessons, I have learned over 25 years of doing this is that if you have well-managed, well-run businesses which generate reasonable amounts of cash, which are business leaders, which have a reason to remain as leaders, you should not bother about trimming a little or buying at the depths or trading around your core position. You should continue with the core position, or at least if you have a core position, then you may trade a little bit around it, but don't disturb it. So let's go back to the first principles, right? If you have a company that's catering not only to India, but to the global market, has a very good solid balance sheet, has business leadership in the business it is in, and is, more of a necessary product than a discretionary product, and the valuations are not terribly expensive, you should just hold on and see through this volatility. Why would you want to turn that into cash and try and time another purchase, hoping that the US election-related volatility gives you an opportunity? But having said this, you also mentioned COVID and China. COVID, I think, is a bigger question. See, COVID, none of us know the extent of the damage that COVID has caused or will continue to cause. That to me is the real risk out there. There's a very interesting article in today's Mint newspaper. Sorry, it's a competitor for you. But where Niranjan Rajadhyaksha has referred to a particular aspect called the demand shock. We still don't understand what is the demand shock which will arise as a result of Corona. And to me, that is the real test. And I think the test of that will be visible during the festival season. And that to me, is something, an event I will watch for very, very carefully. And China, of course, has both political issues and it has, other issues related to it. So, that situation one has to watch very closely.
How realistic do you think this time is going to be the push towards manufacturing? Because if we are able to get it right, because now that labor reform has kicked in, cost of capital is getting better, there is a global angst against using Chinese-made products. If we are able to get the manufacturing sector right, do you think it will throw up outside gainers, or this is still storytelling right now, no point in focusing in it?
My sense is that it should do well. If you look at, especially places where we have a very large domestic market, I think you could easily build a scenario where companies that are very large in India could become, a base for exports to the rest of the world. We often don't think about autos in that way, but if you think about it, India has global competitiveness in two-wheelers today. India has probably global competitiveness in small cars. In manufacturing, if you have a large scale in the domestic market and we sort of give it a little bit of a nudge, which the government appears to be doing, you could easily become very, very large, from a global marketplace perspective. So I think it's a very interesting time. It's not just the cost of capital, it's the size of capital. Look at the size of FDI that's coming into India. Today, I think you have finally reached a point where, if you had to sink in a couple of, $1 billion into a very large opportunity over, let's say, 2 or 3 years, it's not a problem. It's not a problem, because there are large pools of capital available to you globally that are willing to back you up if you have the right entrepreneur, if you have the right market opportunity, and the government seems to be doing its bit. So yes, I'm quite optimistic that some opportunities will emerge out of it. I just hope that we use that opportunity correctly, and from an administration perspective, things don't go wrong. You had the factory from Nokia, right, in Tamil Nadu, which of course had a certain outcome. Those are the things that we have to watch for, that we don't get, swayed by short-term revenue targets and lose sight of the bigger picture from a policy perspective. That's what I would hope for.
All right, Ashwini, thanks so much for joining us this morning. Great
Thank
chatting
you.
with you.
Thank you. Bye-bye.